Clement, thank you for your time today. So, well, you did take also a look at the economy for this year, the market in 2020, but I would like us to quickly just focus on the banking sector first. You did highlight some of the highlights. You talked about the fact that Nigerian banks are not ready for a loan-to-funding ratio of 70%. I suppose those are the banks under your coverage, a couple of names under your coverage. Just walk us through some of those key highlights.
Okay, so what we've seen in the recent time is we've seen the CBN come with a loan-to-funding ratio of 60%, and it has increased to 65%, and the CBN have used that to try to spur lending to the Nigerian economy. So what we've seen is in the last half of 2019, we see about 2 trillion naira loans coming to the Nigerian sector, into the economy, and what we try to see is, can this bank actually take a loan-to-funding ratio of about 70%? And how will this impact the bank's capital? So from our analysis, what we discovered is a loan-to-funding ratio of about 70% would translate to a loan of about 3.3 trillion naira. Okay. And we don't think our coverage bank can take that in the space of the next 6 months. We think that's heavy. We consider the impact of that on the capital adequacy ratio of the bank, and we find that that's going to shave off about 400 basis points from the bank's capital if the banks were to take a loan-to-funding ratio of 70%. And also, mind you, you also need to understand that given that there's also not, I'll call, lack of quality opportunities for credit growth, and these loan growth are being forced into the system over a short period of time. So what you're going to see is you're going to see lower quality of credit assets, which can bring about asset quality issues in the medium to long term. I'm
just wondering, because we have seen that steady rise in loan growth, across the banks, both across the tier 1s and the tier 2s. And the CBN seems to be satisfied with this growth, but I suppose perhaps on the bank side that may be a different story, based on what you're saying now. But we're expecting this growth to continue, and I'm just wondering at what point what red flags could begin to pop up that would indicate to us that okay, this may actually start becoming a problem.
Okay, so what we've seen is now there's an issue of higher CRR coming on board. Okay. And if you look at these two policies, you see that they're kind of divergent. So at the one hand, you have a minimum loan-to-funding ratio of 65%. At another hand, you have CRR going up by 500 basis points. One typically should restrict the 500 basis point increase in CRR should reduce or inhibit credit growth, while the minimum LDR should spur loan growth. So with different policy, you see that the banks are actually confused. What we've seen over time is towards Q4, going by Islamic results, you see banks letting go of deposits, trying to meet the loan-to-funding ratio, because these opportunities are not just there, and they've been trying to lower their funding. But now, on the other hand, banks need to go after funding now because the CRR has gone up. So the debit has come in. So we've seen the bank turn between a hard place and a very difficult place in 2020. And so I think the investors need to keep looking at the body language of the CBN.
You also tell investors to keep an eye on asset quality because, buffers for the banks, capital buffers may also be eroded at some point.
Yes, so because of the aggressive loan growth that we've seen in a short period of time, you see that capital is actually beginning to thin out. And because of that, if there should be a significant, let's say, credit asset challenge, you're going to see that effect the impact come more on the banks. And also with the higher CRR now, from our estimates, for every 100 basis point increase in CRR, the banks typically lose an average of 50 basis points in ROE. So based on from what we understand, we believe that this 500 basis point increase in CRR that we've seen in recent time is going to be applied incrementally. So irrespective of what your effective CRR is, based on the interactions we've had with some of our banks, irrespective of what your CRR is, it's going up by 500 basis points, which means the banks can potentially lose about 250 basis points in return on equity on the back of that, if this is sustained.
I suppose the next MPC meeting, if this continues, will be quite an interesting one. And obviously, they are keeping their eyes on activities in the banking sector. Thank you, Clement, for talking to us today. Appreciate your time on the show. Clement Adewuyi, banking analyst at RMB Stockbrokers.